Imagine you've spent the better part of a decade training millions of people to happily or even eagerly, pay a massive premium for your athletic wear.
Right, just building up this incredible aura of exclusivity.
Exactly. You never put your core items on sale, like ever. Your brand is basically a status symbol.
It's the ultimate uniform for a certain demographic.
Yeah, and then suddenly you find yourself essentially begging those same loyal customers to take your excess inventory off the clearance rack.
It is such a profound shift, honestly, a total shift in consumer psychology.
So today on Talk Tickers, we are looking at a company where that gravity-defying business model just kind of hit the floor. Welcome to this special Talk Tickers deep dive.
Thanks for having me.
All right.
When we look at Lululemon, ticker symbol LULU, we're looking at a brand that historically possessed what Wall Street calls impenetrable pricing power.
Impenetrable. I like that word.
Yeah, I mean, the assumption was always that their specific target demographic was immune to macroeconomic pressure.
But they just wouldn't care if inflation went up.
Exactly. The assumption was that the brand's moat was simply too wide to be breached by standard retail gravity.
But the Q1 2027 earnings call kind of shattered that assumption, didn't it?
Oh, absolutely shattered it.
Which is why we're dedicating this deep dive to strictly looking at this through the lens of the retail investor. So for you listening right now, our mission today is simple.
We have the transcript, the raw data, the management guidance, and quite honestly, a rather bewildering list of excuses from the executive team.
Bewildering is putting it nicely. Our job is to translate the corporate speak, figure out the actual mechanics of what broke down, and give you a clear, actionable verdict.
Right, because you need to know if this stock is actually worth your capital right now.
And we usually try to keep these Talk Tickers formats super concise, but there is so much to unpack here.
There really is. This specific quarter requires serious unpacking because the disconnect between the top-line revenue number and the underlying health of the business, it's just vast.
Yeah, let's start right there with the headline numbers. Because if you just glance at the headline revenue, you might think things are moving along fine.
You really would. On paper, Lululemon reported Q1 net revenue of $2.5 billion.
$2.5 billion. Which is what, up 4% overall from the prior year?
Yes, up 4%, or a 2% bump if we adjust for constant currency.
Okay, wait, let's pause for a second. Constant currency, just translating that for the listener real quick.
Oh, right. That just means stripping out the effect of fluctuating exchange rates. Since they sell globally, if the US dollar is really strong, foreign sales look smaller when converted back.
Right, okay. So either way, 2% or 4%, a casual observer sees that and thinks, well, they are still growing. They're still moving more product.
But that 4% revenue growth is essentially a mirage.
A mirage masking a structural decline, right? Because we have to look at the comparable sales.
Exactly. Their comparable sales actually decreased by 2%.
Okay, let's break that down. Because that negative 2% comparable sales figure, or comps as Wall Street calls it, that's the real story here.
It is the central nervous system of this entire earnings report. To understand why that is so damning, we have to look at the mechanics of retail growth.
Right, because there are really only two ways a brick and mortar retailer can increase total revenue.
Yeah. The hard way is to get more people to walk into your existing stores and buy more items.
Which is what you want.
Obviously. But the easy way is to just sign a bunch of new commercial leases, build new stores, and buy more cash registers.
I always call this the treadmill effect. Like if I own 5 coffee shops making $1 million each, I have $5 million in revenue.
Solid business.
Right. But if my coffee starts tasting terrible and I lose 10% of my customers at those 5 shops, my revenue drops. It goes down to $4.5 million.
Which is a panic moment for a business owner.
Total panic. But if I quickly open 2 brand new coffee shops, suddenly my total revenue jumps to $6.5 million.
Even though the coffee is still terrible.
Exactly. I can go to my investors and brag about my massive revenue growth, completely ignoring the fact that my core product is failing.
And that is a perfect mechanical breakdown of why Wall Street obsesses over comparable sales. Comps strip out all the revenue generated by stores opened within the last 12 months.
It isolates the established footprint.
Yes. It asks the crucial question, are the stores we already had doing better or worse than they were exactly 1 year ago?
And for Lululemon, the answer is worse. By reporting a negative 2% comp alongside a 4% total revenue increase, they are admitting their established footprint is losing momentum.
They only achieved that top-line growth by forcing it through footprint expansion. Fewer people are converting in their legacy stores.
And when you are forcing growth through expansion while your core stores bleed traffic, The bottom just falls out of your profitability.
Which brings us directly to the earnings per share, or EPS.
Yeah, this was the shocker for me. Last year in Q1, Lululemon delivered an EPS of $2.60.
A very healthy number.
But this quarter, that EPS collapsed to $1.69.
Massive drop.
That isn't a slight miss. That is a catastrophic erosion of profit. It's like getting a 4% raise at your job, but your rent and groceries suddenly spike 40%.
That's a great way to look at it. You are technically bringing in more gross dollars, but your actual take-home wealth is plummeting.
You feel significantly poorer despite the raise, and we see the exact source of that profit erosion in their gross profit margins, right?
The margin bleed is brutal. They reported gross profit of $1.34 billion.
Which sounds like a lot of money.
It sounds massive, but as a percentage of net revenue, it came in at 54.2%.
Which means what compared to last year?
That represents a 410 basis point drop compared to the same quarter last year.
Okay, I want to pause on that 410 basis points figure. Because in the premium apparel world, a margin drop of over 4%, which is what that means in a single 12-month window, is a massive red flag.
It is flashing neon red. It tells us that the fundamental unit economics of selling a pair of leggings or a sports bra have severely deteriorated.
And Megan Frank, who is the interim co-CEO and CFO, tried to explain this margin bleed on the call.
She did. She pointed heavily at tariffs, actually. She claimed tariffs alone accounted for a 280 basis point negative hit to their margins.
So just to clarify for the listener, tariffs act as this invisible anchor on retail profitability, right?
They are essentially a tax levied on imported goods. They hit the cost of goods sold before the product ever even reaches the stockroom.
But here's the critical mechanism, and why this matters so much for Lululemon specifically. When a brand faces a spike in import costs, they have a choice to make.
A very difficult choice.
Right. If their brand power is truly invincible, they simply raise the retail price of the garment. They pass that tax directly onto the consumer to preserve their own profit margin.
But Lululemon didn't do that. Or, well, they couldn't do that.
They couldn't. The fact that they absorbed a 280 basis point margin hit tells us they finally hit the ceiling of their pricing power.
They looked at the current macroeconomic environment and realized something scary. If they tried to push a $120 pair of leggings to $130 just to cover the tariff, the consumer would simply walk away.
So they had to eat the cost. And you can see the bizarre ripple effects of this in their inventory data.
Oh, the inventory data is fascinating.
It is. The CFO noted that units of inventory actually decreased by 4% year over year, but the dollar value of that inventory increased by 2%.
Let's look at the mechanics of that, because it sounds contradictory at first.
Right, wait. They are physically holding fewer items in their warehouses, like 4% fewer actual garments, but the financial cost of holding that smaller pile went up by 2%.
Exactly, because the raw materials, the shipping, and those heavy tariffs made the acquisition cost significantly higher per item.
Wow. So the sheer weight of acquiring the goods is crushing their margins. But tariffs only explain 280 basis points of that drop. We still have to account for the rest of it.
Right. The total drop was 410. So we still have a gap. And that is where management had to admit to a spike in markdowns.
The dreaded M word in retail.
Yep. Markdowns accounted for another 40 basis points of the drop, alongside what they call fixed cost deleveraging.
Fixed cost deleveraging. That's a mouthful. Let's translate that. It's really just the harsh reality of running physical stores, isn't it?
It absolutely is. You have to pay the same monthly rent, keep the same number of lights on, and pay the same number of floor staff, whether you sell 1,000 shirts or 10 shirts.
So when your comparable sales drop 2%, those fixed costs suddenly consume a much larger slice of your revenue pie.
The math turns against you very quickly.
Okay, so if the margins are collapsing overall and the stores are generating less organic cash, let's look at the geography. Where is the epicenter of this bleed? Let's move to section 2, the story behind the numbers.
The regional divergence here is stark. North America is the undisputed engine of Lululemon's business.
And that engine is sputtering.
Badly. North American revenue dropped 3% overall. And if we look closer, the U.S. market specifically dropped 4%, and Canada was down 3%.
But then you look at China, and it's like a completely different reality.
It really is. Management reported that revenue in mainland China was up 30%, with comparable sales jumping 13%.
Wait, 30% revenue growth? That's huge.
It is huge, but we do have to apply a slight mathematical filter to that China figure.
Oh, right, the holiday shift.
Yeah, management noted that the timing of the Chinese New Year shifted into Q1 this year. That artificially inflated that growth rate by about 8 percentage points.
Okay, so if we strip that 8% out, it's still a 22% adjusted growth rate in China, which is remarkable.
Very remarkable. They hosted a massive yoga event on the Great Wall with over 2,000 guests, and they are heavily promoting the upcoming Summer Sweat Games over there.
So the international momentum is definitely real. I saw the rest of the world segment outside of North America and China still managed a 13% revenue increase.
They are definitely finding a foothold abroad.
I see the international growth, I do. But I have to push back on the idea that it balances the scales.
How so?
Well, you can open your first store in Greece or plan a massive rollout in India. But if the North American mothership, the market that dictates the vast majority of your cash flow, is contracting by 4%.
I see where you're going.
Yeah, global expansion isn't a victory at that point.
Yeah.
It almost feels like a desperate attempt to outrun the domestic rot. The North American consumer is the core of this brand.
That's a fair assessment. You can't ignore the core.
So why did that core consumer suddenly stop buying? That's what we really need to figure out.
That is the most scrutinized part of this earnings call. Megan Frank explicitly stated that February and March were relatively strong.
Okay.
But then traffic completely fell off a cliff in the last 6 to 7 weeks of the quarter.
A cliff. Just totally vanished.
And the reasons management provided for this sudden deceleration are highly debatable.
I couldn't agree more. They basically blamed two primary factors. The first was a spike in negative social media commentary, and the second was a fashion miss with their wide leg pants.
Let's tackle that social media excuse first, because this fascinated me when I read the transcript.
It's wild. When analysts pressed them on what this negative commentary actually was, management vaguely pointed to a proxy contest and questions around product composition.
I have a really hard time digesting this proxy contest excuse.
Right. A proxy contest is a boardroom dispute. It's when an activist investor tries to muscle their way into corporate governance to change the strategic direction of the company.
It's pure Wall Street inside baseball.
Exactly. Does a college student or a young professional walking through a mall looking for workout gear actively monitor corporate proxy battles?
Absolutely not. It feels like management is using complex corporate drama as a shield to hide from the reality of consumer fatigue.
It's such a weak deflection. Institutional investors care about proxy contests. Consumers care about the product.
Now, the second part of their excuse questions around product composition that has far more mechanical validity.
You think so? Like fabric quality complaints?
Yes. If there is a viral trend on TikTok claiming the fabric of the Align leggings has changed, or that the material is suddenly pilling after one wash.
Oh, or that a certain batch is see-through.
Exactly. If that hits the algorithm, that will absolutely stall conversion rates. We've seen product quality virality crush apparel brands for an entire fiscal quarter before.
Okay, fair. But even if there was a localized uproar over fabric quality on TikTok, blaming a fundamental 4% drop in U.S. sales on 6 weeks of internet noise just feels deeply defensive.
It implies the underlying business is flawless and they just got temporarily unlucky with the algorithm.
Right. It completely ignores the possibility that inflation is finally squeezing their affluent demographic.
Yeah.
Or that competitors like Elo Yoga or Vori are simply stealing their market share.
Which is precisely why Wall Street analysts kind of brushed past the social media excuse and zeroed in on their second excuse, the internal merchandising failure.
Ah, yes. The new look of yoga campaign.
Management actually admitted they missed the mark with this campaign. They specifically cited their away-from-body styles.
Which is just corporate speak for baggy pants.
Plain English, they bet heavily on baggy, wide-leg yoga pants, and it disrupted their entire sales ecosystem.
This is where the mechanics of apparel retail get genuinely fascinating for me. Management claimed that the customer response to the baggy pants themselves was actually okay.
But they failed to generate the anticipated halo effect.
Yes, the halo effect. Let's break down how that actually functions on a store floor, because the entire geometry of a Lululemon store is designed for outfit completion.
They do not want you buying just a pair of pants.
Never. The merchandising strategy relies on visual adjacency. If you walk in to buy a trending, tight, high-waisted legging, the display is meticulously built to show you the perfectly proportioned cropped tank top that matches it.
And the half-zip sweater that layers over it.
And the color-coordinated belt bag sitting right next to it. The new trendy item is the bait. But the high-margin basics and accessories are where they actually make their profit.
It's the concession stand dynamic.
Exactly. The trendy new pant is the blockbuster movie. If the movie is a hit, people buy tickets, walk into the theater, and then spend $15 on popcorn and soda.
But Lululemon is essentially admitting that with these wide-leg pants, people bought the movie ticket but walked right past the concession stand.
So mechanically, why did baggy pants kill the outfit completion? Why didn't people buy the matching tops?
It comes down to silhouette proportion and inventory alignment. If your core customer is used to buying form-fitting leggings, they likely already own tops designed to balance that tight silhouette.
Usually looser tops or oversized hoodies.
Right. But when you suddenly introduce a dramatically wide-leg baggy pant, the customer needs a completely different style of top, usually something very tight and cropped to balance the visual proportion.
Oh, I see. So if Lululemon pushed the baggy pants, but didn't adequately pivot the surrounding inventory of tops to match that specific new silhouette.
Then the consumer tries on the pants, realizes none of the adjacent tops look quite right with them, and buys the pants alone. Or worse, they buy nothing at all.
Wow. And this merchandising friction is compounded by their aggressive push for what they call newness, isn't it?
It definitely is. Management noted on the call that they intended to increase the penetration of new styles in their assortment from 23% last year to 35% this year.
35% new styles. That is a massive jump.
They are currently hovering around 30%, so they are actively shoving a massive volume of new cuts, bizarre seasonal colors, and experimental silhouettes right into their stores.
But if those experimental pieces don't trigger the halo effect we just talked about, you are left with a staggering logistical nightmare.
Like what?
Well, if you produce a highly specific shade of neon coral in a wide-leg pant, and the matching neon coral sports bras aren't moving because the proportions are wrong, those sports bras become dead weight.
You cannot keep highly specific, non-core seasonal colors on the floor indefinitely. They start to rot your inventory metrics.
Which forces the brand to heavily discount them just to clear physical space in the back room.
And that exact mechanism perfectly bridges the gap to Section 3. Management guidance.
Right, because if the current floor is cluttered with mismatched, poorly proportioned newness, what is management's plan for the rest of the year?
The guidance is where the gravity truly sets in for the retail investor. It's gloomy. Management is forecasting a Q2 revenue decline of 2% to 3%.
So they're aiming for a bracket between $2.45 billion and $2.475 billion.
But the real shockwave is in the projected earnings per share.
Here we go.
They are guiding for an EPS of just $1.76 to $1.81 in Q2.
And to put that in perspective for you listening, their Q2 EPS last year was $3.10.
They're bracing to have their profitability nearly cut in half.
Cut in half. And the mechanism driving that profit destruction is entirely self-inflicted, isn't it?
Yes. They explicitly warned investors that markdowns will increase by 50 basis points for signal clearance.
They are mathematically modeling a massive discount event to flush the system.
And the pain isn't localized to just the summer either. Their full year 2026 outlook projects revenue to be entirely flat or potentially down 1%.
So the bracket is roughly $11 billion to $11.15 billion. Flat.
Flat. But more concerningly, they expect their operating margin for the full year to decrease by 380 basis points.
So we're looking at a company admitting that the next 9 months are going to be defined by shrinking sales and collapsing margins.
It's a tough pill for Wall Street to swallow.
So the obvious question is, how are they fixing the machine? They outlined a few strategic pivots, starting with the executive suite.
Well, the company is currently being managed by two interim co-CEOs, Megan Frank and Andre Mastrini.
Right. But the permanent fix relies on the incoming CEO, Heidi O'Neill, who doesn't even arrive until September.
Operating under interim co-leadership during a massive margin crisis is incredibly difficult. Interim leaders rarely have the mandate to execute painful, sweeping structural changes.
Because they're just keeping the seat warm.
Basically, their primary job is usually to stabilize the ship and clear out the wreckage so the incoming CEO can start with a clean slate.
And that clearing of the wreckage is exactly what we're seeing in their supply chain and merchandising adjustments.
Yeah, they mentioned heavily leaning into what they call chase capabilities, aiming to chase 20% more volume this year compared to last year.
Let's break down what a chase actually means in the context of an apparel supply chain, because it's fascinating.
In traditional apparel retail, the lead time from concept to store shelf is astonishingly long. It's typically 18 to 24 months.
Wait, 2 years?
Yeah, you have trend forecasting, fabric sourcing, initial design, prototyping, fit testing, mass production in overseas factories, and then ocean freight shipping to North America.
That is wild.
Yeah.
Because of this massive delay, a brand like Lululemon is essentially guessing what will be popular 2 years in the future.
Right, and chasing is the exact opposite. It relies on real-time data.
Oh, I see.
If you notice a specific black tank top is selling out within 3 days of hitting the floor, a robust chase capability allows you to bypass that long-term planning cycle.
You just go straight to the source.
Exactly. You directly contact the factory and rush order a massive replenishment of that exact CU. You often use faster air freight to capture the demand before the trend dies.
So by chasing 20% more volume, they're openly admitting their long-term forecasting has been failing, and they're trying to become more reactive.
But you can't just mandate speed without restructuring the underlying pipes.
Right. Megan Frank stated they're actively shrinking their overall product development cycle. They've managed to reduce the mainline process from that 18 to 24-month window down to 15 to 16 months.
With an ultimate target of 12 to 14 months.
Shaving a full year off a global supply chain is a monumental logistical undertaking.
It requires integrating your design teams far more intimately with your overseas fabric mills and drastically reducing the number of prototype revisions.
But if they can actually hit a 12-month cycle, it drastically mitigates their risk, doesn't it?
Massively. When a fashion miss occurs like the baggy pants, a 24-month supply chain means you are stuck dealing with the ripple effects of that mistake for 2 years.
You just keep getting shipments of baggy pants you don't want.
Exactly. But a 12-month supply chain allows you to flush the mistake and pivot to a new silhouette in half the time.
That makes sense. But speeding up the pipeline doesn't fix the problem of what is currently sitting on the shelves right now.
No, it doesn't.
And this leads to what I think is the most revealing operational admission of the entire earnings call. Andre Mastrini detailed a new presentation strategy for North American stores,
which involves removing 15% of their total SKUs start keeping units.
To understand how massive a 15% reduction is, you have to visualize the cognitive load on a consumer walking into a retail space.
A SKU isn't just a style of shirt.
No, it is a specific style, in a specific size, in a specific color. When a brand pushes newness too aggressively, as Lululemon admitted they did, the store floor becomes overwhelming.
You walk in looking for a basic pair of running shorts, and you are confronted with 4 different lengths, 3 different pocket configurations, and 12 slightly varying shades of blue and purple.
It induces the paradox of choice. The human brain looks at 40 microscopic variations of the same garment, gets completely fatigued by the decision-making process, and ultimately decides to buy nothing.
Furthermore, think about the retail staff. The people working the floor have to memorize the technical differences between all those SKUs to properly sell them.
They have to physically fold, sort, and organize that cluttered mess in the back room.
By slashing 15% of the SKUs, management is openly confessing that their stores became disorganized, overly complex, and fundamentally confusing to shop.
It's a huge admission.
It is a necessary structural repair, though. A less dense, highly curated presentation always drives higher conversion rates in premium retail.
But the short-term pain of that decision is brutal. You can't just vaporize 15% of your inventory. If you are removing those SKUs from your core floor plan, they have to go somewhere.
They go straight to the discount racks.
Precisely. Which ties directly back to their guidance of increasing markdowns by 50 basis points.
They're taking the margin hit right now to forcefully clear the clutter, hoping that a streamlined, highly curated store floor will be ready and waiting for Heidi O'Neill when she takes over in September.
This perfectly sets up Section 4, the bottom line. Let's give the retail investor our definitive stance here.
We've dissected the collapsed margins, the regional divergences, the merchandising missteps at the halo effect, the massive supply chain pivots, and the intentional clearing of inventory.
So what is the actionable conclusion?
If we synthesize the data, the guidance, and the structural reality of their operational pivots, the verdict has to be heavily bearish in the short to medium term.
Bearish.
The fundamental thesis for owning Lululemon stock has always been their premium pricing power. The moment a premium brand relies on systemic, planned markdowns to manage their own inventory mistakes, the fundamental investment thesis cracks.
I completely agree. It's like trying to board a high-speed train while the conductors are actively tearing up and replacing the tracks directly ahead of you.
That's exactly what it feels like.
The infrastructure repair, they're attempting shrinking lead times by 12 months, slashing 15% of SICU complexity, chasing reactive volume. These are massive corporate overhauls that require quarters, if not years, to execute flawlessly.
And right now, there is no permanent CEO at the helm to oversee the transition.
Exactly. The interim management is openly telling investors, we are going to suffer through declining revenue, we are going to slash prices to clear out our own mistakes, and our profit margins are going to bleed out for the remainder of the fiscal year.
From an investment standpoint, there is absolutely no immediate catalyst to jump in. If you are sitting on cash hoping to buy the dip because the stock price looks cheaper than it did 6 months ago, you are attempting to catch a falling knife.
A falling anvil even. And if you are currently holding the stock, hoping for a rapid V-shaped recovery in the next quarter, the math simply doesn't support that hope.
You have to brace yourself for a rocky, volatile summer defined by clearance racks, heavy tariff pressures, and the continued sluggishness of the North American consumer.
The underlying brand might eventually stabilize under new leadership, but the financial wreckage will take time to clear.
The structural repairs they are initiating are logically sound for the long term, but they offer zero short-term relief to the balance sheet.
Well said. As we wrap up this Talk Tickers analysis, I want to leave you with one final thought regarding the psychology of the consumer.
It's a dangerous game they're playing.
It is incredibly hard to build a premium brand, but it is very easy to break one. If Lululemon spends the next 2 quarters aggressively training its loyal customer base, that if they just wait a few weeks, that $120 item will inevitably end up on a clearance rack for $79.
Right.
How do you ever convince that customer to pay full retail price again? Once the illusion of invincibility is broken and the consumer gets addicted to the discount, can a new CEO in September really cast that premium spell a second time?
It's going to be an uphill battle. Keep your eye on how deep those discount bins get this summer.
Absolutely. Thanks for joining us on this deep dive, and keep your portfolios sharp. We'll see you on the next one.